What happened in Q2 2024 and what's next? Let's talk about it. All right, Stephen Tuckwood, Director of Investments here at Modern Wealth, joining me, Dean Barber, for the Q2 update of 2024. Tuck, let's review what's gone on in Q2 here. Your take on the Fed's moves, your take on the markets. We'll maybe talk a little bit about interest rates. Let's dive in with the 4 Fed meetings that have happened so far this year. Tuck, welcome.
Great. Yeah, thanks. Thanks, Dean. Appreciate you having me. Been a really interesting Q2 in terms of the change in the Fed speak. And, we have this table here just looking back at kind of key excerpts from their statements of the 4 meetings that they've had so far this year. And January, March, they had this language around inflation has eased over the past year, but remains elevated, and they repeated that in March. And then along came the May meeting on May 1st, and there was a big change in that section of the press release. And it was, in recent months, there has been a lack of further progress towards a 2% inflation objective. And, the market really keyed off of that. And that suggested that obviously not as much progress on the inflation front as they would hope. So, again, rates looking to remain elevated was the big takeaway there. That changed slightly in June 12th, where they modified that language of lack thereof to modest further progress on the inflation target. So, really an interesting evolution of Fed speak in the first part of the year there.
Yeah, no, I think it's interesting. And, the Q2 stock market really was quite nice. April was a rough month to start the quarter. And, as you do every single year, you heard people doing that old, sell in May and go away. Well, if you did that, you captured all the losses in April, and then you didn't get any of the May and June rallies, which were quite substantial.
Yep, exactly. It's like you say, it was a really difficult start to Q2, with April being a down month in the kind of mid-single digits for the S&P 500. And then, a big turnaround that's continued into June here, and we're looking to close out the quarter on with a nice return across risky assets. So that's the equity market, and maybe we wanted to pivot to the fixed income market. It's been challenging still in that rates have been progressively edging higher as the market's digesting these Fed statements and the expectation for rate cuts into the future. I think a lot of the market prognosticators came into this year expecting multiple rate cuts, and over the course of the first half, that's really, the expectations have changed there, and rates look to be higher for longer. And obviously has an impact on the fixed income market.
It has been challenging for sure for the bond aggregate of down nearly 2% on a year-to-date basis. One of the things you wanted to talk about was where the inflation and the labor market meet. So explain this chart here real quick.
Yeah, well, this is the employment cost index, and it's honed in just on the private sector here. And if you think about our economy, what we know is it's very much service orientated. We make some things as well, but we're predominantly a service economy. So wages and wage inflation is really key to the overall inflation picture in the United States. And this is showing that year-over-year growth in employment costs. And you can see from the great financial crisis back in 2008, we had this kind of steady increase up, and then it just got parabolic post-COVID. And got to really uncomfortable levels. And that's essentially why inflation has been so sticky, I think. So it's come down, it's eased, but it's not come down to the extent that the Fed would like. You see, we're still kind of above 4% on the latest reading here on a year-over-year basis. So, as long as this maintains where it is, it's just going to be hard for that inflation rate to get back to their 2% target if employment costs in general are double that. So I think this is really a key indicator that the Fed's particularly honed in on recently.
And I think another thing that's frustrating with the inflation part of it is I see the deficit spending that's happening by our current administration really fighting the Fed's objective to get inflation down, because it's very difficult to get inflation down as we continue. I mean, the deficit spending looks like we're in some sort of a major recession trying to bail ourselves out of it. And obviously, a deficit spending is not helping with the fight against inflation.
Yeah, exactly right. Yeah, it's supposed to be there as a a measure to use during difficult times when we go into deficit spending at the federal level. It's really there to boost the economy in times of need, but we've turned it into this just permanent state where we're just pretty much in a deficit every year now, it seems.
Yeah.
So it is. Yeah, it's definitely not helpful from an inflation standpoint.
Let's take a look at where the Fed fund rates are today, and kind of a little bit of a historical look at that here, Tuck. I know that we've seen typically after the Fed goes through an aggressive rate hiking cycle, leaving rates elevated for some period of time has tended to lead to inflation. And, we talk about this objective for a soft landing. And I think if we want to get the soft landing, we probably need to call Sully Sullenberger to come in and help us out with landing this whole situation here, because the Fed has not had a really good history of being able to provide a soft landing. In other words, slowing inflation and at the same time avoiding a recession.
Yeah, I think historically, as we look back at the Fed's actions, they're typically behind the curve. They're typically reactionary as opposed to being proactive with their decision making. And that's because they're so, as they say, data dependent. Well, if the data's already printed, then you're likely, behind the ball. But yeah, this is a great look back on the federal funds rate, that base rate that the Federal Reserve Open Market Committee sets. And yeah, you can see that they raise it when they want to cool the economy, and they drop the rate when they want to stimulate the economy. And the peaks, it doesn't often stay at the peaks for very long. Maybe a few months to a year, but not much longer than that. And the Feds then has to react to a cooling economy more than they expected and drop rates down. So it definitely feels like we're getting long in the tooth in terms of having rates this high, but again, it's rarely that stickiness of inflation that's leading it to remain where it is.
Yeah, it's interesting whenever the Fed waited so long to start raising rates in the face of inflation. It would be interesting to put the inflation chart on top of this Fed funds chart, because inflation really started to rear its ugly head very, very strongly in 2021. And we kept hearing the word that inflation is going to be transitory, meaning temporary, and the Fed stayed at that zero interest rate environment, in my opinion, for way too long, exacerbating the inflation issues.
Yeah, I think that that they kept repeating, transitory, is really going to go down in history as one of the big mistakes that the Fed made. And I think looks relatively obvious to a lot of people at the time that just wasn't going to be the case. So it was, interesting that they kept with that mantra for as long as they did. And it was obviously, in hindsight, a mistake to do so. So I think they're, trying to learn from their own lessons, and they, really want to see inflation just come down, I think, before they do materially drop the federal funds rate.
Now, we did hear Powell say, and this is really what started the rally back in October of 2023 that has persisted with just one little interruption in April of this year, where, Powell said, I'm not going to wait until the 2% target is hit to begin to cut rates. We have started to see that number come down. We're a little above 3% on a year-over-year basis on inflation, but it is trending lower. So for the balance of the year, Tuck, what do you think is going to happen from a Fed perspective? Do you think we get one rate cut in the fourth quarter?
It's hard to tell. If I was a betting man, I'd suggest no. So we have a July meeting on the 31st of July, then we have another on September 18th. The third one to come in the back half of the year here is November 7th. And that's just 2 days after Election Day. So I'd almost write that one off. There's just not much happening there from the Fed. They like to keep, their view of independence. So I think they're just frankly running out of time to do it. There are only 4 meetings left on the calendar. As I said, one of those is likely a dud. So, there is a chance, but as long as that employment cost index remains above 4%, I just think they're going to struggle to be able to do that.
Yeah. Okay. Well, it remains to be seen, but I think if we think about the fixed income market and what the Fed's control over that fixed income market really is, we still have to take a longer term view of fixed income, and we have to understand that really there's opportunity in the fixed income market today because you're able to buy, high quality fixed income instruments at par, sometimes some below par, maybe some just a little above par. But if we think that eventually, even if it's 24 to 36 months, that interest rates are going to be lower than they are today, that still presents itself as a good opportunity for kind of extending duration a little bit on the fixed income that you own today, or adding it if you don't own it.
Yeah, exactly right. I think that's the big decision for folks who are allocated heavily into either money market funds or really short-term instruments that are very safe and they're earning a great return, 5 to 5.5%, because that's where the federal funds rate is. Well, to earn that today on a look forward, the federal funds rate has to remain where it is for 12 months. So, I just encourage folks to really think about things that way. And, I think it is a good time to start thinking about extending duration, as you said, and locking in some of these higher rates a little bit further out. It might not be 5.5%, maybe in the mid fours, but to lock it in for longer, and that, helps the portfolio overall if the Fed does end up lowering rates at some point in the future here.
So let's switch gears to equity markets, and a lot of questions out there as whether or not this rally is real. It's been driven by a small handful of stocks, NVIDIA the most notable, on a parabolic move upward. But your chart here suggests that overall earnings growth in the S&P 500 for 2024 is strong, and consensus is that continued earnings growth could continue into 2025. Tell us what we're seeing here, Chuck.
Yeah, so as you said, Dean, this is the S&P 500's earnings growth every year, and the two green bars there all the way to the right are estimates at this point. So we're obviously halfway through the year for 2024, and it's looking strong. Likely we'll end the year, somewhere in the double digits in terms of a year-over-year growth number, which is great. It supports a rising equity market. If earnings aren't rising with the market, then it's multiple expansion, and that can't last forever. So we always want to see strong earnings growth to support a rising equity market. 2025, these are analyst estimates right now, kind of the consensus there across the street. And they tend to be positive anyway, and they're often very wrong. So, we don't put too much weight in forward look that far. But for this year at least, what's on the book so far and, how things are shaping up for the remainder of the year, it does look like it's going to be a really decent year in terms of S&P 500 earnings growth on aggregate. And, I think that's an important distinction here, that it is being predominantly driven by, focused on a few names. You mentioned NVIDIA, and there's some others that are doing the lion's share of that lifting. But we are starting to see some improvement, kind of dispersion of earnings from other companies as well. So, we're looking okay there.
Okay, so let's finish this up, Tuck, with a quick discussion about the price to earnings ratio on the S&P 500 being significantly elevated. But at the same time, there are a majority of companies in the S&P 500 that are actually trading at lower price to earnings ratio than what they should be. So you've got some real disparity here from some companies that are very richly valued versus some companies that are actually undervalued. But on average, if you look at the weighting of the S&P 500, it's elevated to a great degree. So does that concern you as we move into the balance of the year, or do you believe that this strong earnings growth can continue to keep this market on a upward trajectory?
Yeah, I'm generally bullish, I think, here, and I think we are going to see a bit more participation across the board from companies that haven't, contributed to the rally too much so far. 2024 has been an extension of 2023 in that regard. That it was a tech and communication services led rally, and that has been the case as well this year. So, like you say, on price to earnings ratios here, it's high, but the earnings growth is there. So, when we have these periods of time where there is a higher PE ratio on the market than historically, one of two things has to happen. Either the earnings growth comes up to match it, or we have a drawdown on the S&P. So but generally I think things are shaping up okay, and hopefully we'll see more participation from other areas of the market as well.
I would hope so as well. Tuck, thank you so much for taking time to join me here for the Q2 Economic Update. Enjoy the rest of your day. Thanks for joining us here for the Q2 Economic Update. If there is anything that you'd like to discuss with our team here at Modern Wealth, please reach out.